Hello, everybody. Thank you for taking time out of your day for this, what I feel will be one of the best webinars we provide our clients, all on year-end tax planning. And I'm telling you, it's so important. Not everybody gets excited about tax, but today's presenters, I can assure you, get very excited about tax. Today, we have Nicole Gobel, who is one of our senior wealth advisors and director of financial planning. She's a CPA and a certified divorce financial analyst. Vincenzo Testa, CPA and certified financial planner, one of our wealth advisors and tax planners. And Scott Strohecker, a enrolled IRS agent, wealth advisor, and tax planner. The three of these team members get really involved in taxes. In today's webinar, I think you're going to find to be very informative for a lot of reasons, and we'll have it up on our website in case you need to come back to it or you want to refer a family member or friend that may be interested in what we have to say. So today we'll be discussing maximizing retirement contributions, distribution planning, real estate strategies, employer stock compensation, gifting strategies, and tax updates. Without any further ado, I'd like to hand off the meeting to my very capable colleague who I think the world of, Nicole Gobel.
Thank you, Steve. So before we get started on maximizing retirement contributions, as you saw, we're going to cover quite a range of topics today. Some of them apply to most individuals, and some will be more specific around real estate strategies or employer stock compensation. Our idea is really introducing these topics, so even if it doesn't affect you, maybe a family member or friend does have that situation. So we want to make sure we're just covering an array of different tax planning strategies. So we really want to make sure, right, that every year we're maximizing our retirement contributions if cash flow allows. So each year, these tend to update by inflation. This year, in 2023, the maximum you can put into an employer plan similar to a 401k, a 403b, a state 457b plan is $22,500. For those over age 50, you can put another $7,500 in, and the base is going to increase to $23,000 for next year. So why is this important? Really ensuring that you're putting the maximum away in your retirement plan each year. If you are doing that through pre-tax funds, that's going to minimize your taxes that you need to pay in the current year. For self-employed individuals, there's a number of different retirement plan options. We have many clients that have a simple IRA, a SEP IRA, a solo 401k plan. So all of these options allow you to put in kind of a combination of contributions. And again, you're acting as the employer as well. So in most cases, you will have until you file your tax return, which can even be the extension deadline of next year to fully fund these plans. Where through normal employer plans, you do need to do that through payroll deductions. So we only have a few more pay periods left to accelerate that if you haven't already. And again, that the total defined contribution plan limit. So again, that is a 401k, a 403b. So that's going to be the combination that you're putting in as the employee, plus whatever match or profit sharing contribution your employer is putting in. The total for this year is $66,000. So that's a very generous amount on top of the $22,500 you can put in. It's going to increase to $69,000 in 2024. So again, where does this come into play? Where if you're a business owner and you and your partners are ensuring that, for example, your employer contribution is hitting that maximum, you want to look at that every year. There's also individuals, though, that don't have access to an employer plan and maybe are working multiple part-time jobs or just starting out. So a traditional or a Roth IRA is a great option. For this year, those under 50 can put $6,500, and you have until April 15th of next year to make that contribution before you file your tax return. That will increase to $7,000 next year. For those over 50, you get an extra $1,000. That's $7,500 for this year, or $8,000 next year. But it's really important to understand the income limits for Roth contributions. If your income is in excess of about $200,000, it's something you may want to look at before you make a contribution, because again, only those under the income limit can make a full Roth IRA contribution, and then it begins to phase out. So make sure you're, again, working with your tax professional or contacting your advisor here at Boucher to make sure that you should be doing that. Health savings accounts are another great way to save for the future. So health savings accounts would be attached to a high deductible health insurance plan. And oftentimes an employer may put a contribution in on your behalf, but you can fund up to $3,850 as an individual. That's increasing to $4,150 next year, or $7,750 as a family, again, increasing next year to $8,300. For those over age 55, you can make one extra contribution of another $1,000. Now, while health savings accounts can be used for current expenses, I have one and use one for my co-pays and out-of-pocket costs. You can also grow these funds long term. Most health savings account will have an investment component. So once you've contributed a certain amount, you can start investing a portion of those funds into low cost funds. So that's something definitely to look at, as you can grow these funds long term and use them later in life for costs as well. Now let's look at the other end. So we just talked about maximizing retirement contributions for those of our client base that are still working and still earning funds. But what if you're kind of on the opposite end and you've now begun to take distributions from your savings to fund your retirement? Tax planning around distributions is just as important, and often more so when you're changing from, again, being employed, earning funds, putting funds away, to now spending down your assets or identifying what income sources you're going to live off of. So in retirement, or even part-time retirement, right? We have many clients who move to that part-time employment first. So maybe they reduce hours at a current job, or they take up a hobby that they've always enjoyed for part-time employment. And that's a great way to transition versus, taking the full leap from full-time job to not working at all. We often see this as a great transition. So you might have part-time employment income, right? That could be, again, just your normal wages with some withholding. You could be fortunate enough to have a pension, right? We work with many state retirees, teachers who retire, or, many individuals who are fortunate enough to work with one of the few companies that still have a pension plan in place. Rental income, and Vinny's going to talk about some real estate strategies, but we do have quite a few clients who maybe have a rental property and they're receiving passive income from that property to help support retirement. Social Security benefits. This is really an important strategy. We work with all our clients. When should you elect? What's the right choice for you, right? There's many different factors to consider, whether it's longevity in your family, whether it's other assets you're going to have to pull from, who's the higher earner in the household, should you wait longer? I know Steve recently shared an article how it does financially make sense to wait until age 70, but most individuals choose not to. So again, work with your advisor to determine what's best for you. Cash savings, right? We often see people have saved a couple years worth of their cash flow needs early in retirement, but should you spend all of that down, or should you leave that as a buffer for future years? And then, of course, where we come in, the investment portfolio, and where should you be pulling from and what types of accounts? So let's talk briefly about how different accounts are taxed. Your after-tax money, or your brokerage accounts that we may be investing for you, of course, you pay tax on the interest and dividends that are paid into your account each year, right? And you get your 1099 tax document that tells you exactly what that was. And dividends on US companies typically qualified are at a lower tax rate, whereas interest, it really depends on where it's coming from. Thankfully, Treasury interest, which we've received a lot of this year, is state tax free. So that's another big benefit of using Treasuries. Whereas ordinary interest from your bank or maybe from a corporate bond is going to be taxed at your ordinary income tax level. And municipal bonds, again, depending on the state it's coming from, could be federal and state tax free, but really depends on that interest rate environment, whether that is an appropriate choice for you. And then capital gains. And there's two types of capital gains here. There's the ones you realize by selling something in the account to take withdrawals. and that could be short-term or long-term gains. And then there's capital gain distributions. Now, thankfully here at Boucher, we manage very tax-efficient portfolios with low-cost exchange-traded funds for most of our clients. But we do have clients who still own mutual funds that we haven't been able to manage out of for capital gains. So take a look at those, because in December, typically they pay out capital gain distributions, and you want to make sure that you're aware of what's going to be paid out. Pre-tax retirement accounts, as we said earlier, great to maximize your contributions. You get the tax benefit on the way in. However, all contributions and earnings are taxed as ordinary income on the way out. These accounts are subject to required minimum distributions, and that age varies. Right now, 73 or 75, depending on when you were born, is when you'll have to start if you're not already of RMD age. But again, it's something definitely to plan around. And then Roth IRAs, right? They're tax-free upon withdrawal. And as I mentioned earlier, you do have to earn under a certain income to be able to contribute. We like to use these as kind of emergency funds, right? If somebody needs a little extra cash during the year, and maybe taking a little bit extra would put them into the next tax bracket, but also they're a great estate planning tool, as although your heirs will typically have to take them out within 10 years, they are tax-free. So when determining really what amount to take out of each type of account to really supplement any other income sources we mentioned earlier, it's important to keep in mind a couple different things. Well, one thing is, how much do you need to pay in as far as taxes each year, especially if you're transitioning from working full-time to not, right? But you're going to be taking distributions maybe from an IRA or electing Social Security. It's really important to understand safe harbor rules. So that's what you need to pay in to the IRS or the state. We'll use New York as an example, to ensure they're not charging you penalties and interest for underpaying. So as long as your income was under $150,000 of adjusted gross income last year, all you need to do is pay 100% of last year, or 90% of this year. If your income was over that amount, you should pay in 110% of last year to protect yourself. However, again, if you're going from being a high earner to earning very little, aiming for that 90% of current year taxes is more appropriate. And that's where Scott, Vinny, and myself, can work with you to do tax projections to determine how much you should pay in to keep yourself covered. New York is actually a very beneficial state to live in for retirement. I know people relocate to Florida or Texas or other states with no income tax, but New York is actually very beneficial to retirees in that Social Security is not taxable, plus the first $20,000 of retirement income for each spouse over 59.5 is exempt from New York state tax. So again, when you're determining what accounts to take from, maybe ensuring you're taking at least that from each spouse's account makes sense to fully utilize those exemptions each year. Medicare premiums is another one we hear about a lot. There is a 2-year look back as to the income they're looking at for what your Medicare premiums are going to be for this year. So for 2024, they're looking at your 2022 tax return. But ensuring you know what those limits are and not taking, just a little bit more, because that could cost you hundreds or thousands of dollars in more premiums. And again, we help our clients plan around this. And last but not least, Roth conversions, right? We get questions all of the time on Roth conversions, and is it appropriate for that person? Often in early retirement, if somebody is living off of more so their cash savings or brokerage accounts and not yet taking Social Security or pension or large IRA distributions, they might be in a very low income tax bracket. It may make sense to move some funds from your IRA to your Roth at a very low tax cost. And then again, that amount is no longer subject to required minimum distributions. The other way we use Roth conversions is almost as a gifting tool. So basically, the tax you're paying during your lifetime to convert funds from your IRA to your Roth, think of it as a gift to your heirs, as now they don't need to pay that tax upon receipt of those funds. I'm now going to pass it off to Vinny, who's going to talk a little bit more in depth about those real estate strategies, such as the rental income I mentioned.
Thanks, Nicole. So real estate can generate some pretty significant tax savings, and it's very beneficial to own real estate when managing your tax situation. Specifically renting out real estate property versus flipping property is the first thing I want to discuss. So flipping property obviously, some folks buy property that needs some work and they put some money into it and then they subsequently fix it up and sell it. So that's going to generate, continuous tax liability being generated. So on the flip side, we have renting out property, and that creates, a source of passive income, and you're able to write off expenses associated with, the operation of the property, right? So, to me, renting out property could be very beneficial. And, one of the major expenses that is beneficial to your tax situation is depreciation, right? So depreciation is basically taking the cost of real estate or other fixed assets within the real estate and taking them as an expense as your taxes, right? There's a common misconception that if you have a mortgage on a property that the principal that you're paying on that mortgage is deductible, but it's kind of captured in this expense we call depreciation, right? So residential real estate property, you depreciate the cost of that over 27.5 years. And when it comes to commercial, it's 39 years. So you're taking that expense year after year against the potential rental income that you could be receiving during that time. And obviously there's other expenses that could be written off against rental income as well. Legal fees, the folks that are keeping maintenance with the property, potentially HOA fees and mortgage interest. So there's a ton of expenses that you could use to write off on your taxes against the rental income you're receiving. And when it comes to depreciation, residential real estate property and commercial real estate property, there's other fixed assets, right? There could be furniture and fixtures, there could be equipment, and these could be sitting within the residential or commercial real estate property that you own. And that's when this very beneficial, kind of loophole that the IRS allows called the cost segregation study comes into play. So this is where you accelerate your depreciation, where an organization or a company can go into your rental real estate and they could say, hey, you have a light fixture here, that's actually depreciable over 7 years, or you have a toilet, that's depreciable over 5 years. So you kind of have this company go in and they accelerate the depreciation, right? They're not grouping the entire property in a bucket of residential real estate, only allowing you to depreciate it over 27.5 years. They start to find other assets within the property and you get to depreciate them faster, right? And how is that beneficial? Let's say, you have a big flux of income coming in a certain year. You could, kind of explore this cost segregation study outlet and, kind of generate as much depreciation expenses as you possibly can. And then lastly, with rental real estate, estate planning, right? When you depreciate property over a long period of time and then you go on to sell it, you have to actually recapture that depreciation as income, right? So you're not just capturing the gain over the cost basis of which you originally purchased it at. You actually have to recapture the depreciation as income, and it's capped at 25% on the federal side in terms of the tax rate. When you leave depreciated real estate to your heirs or beneficiaries, they actually receive a step up in basis, right? So if they were to receive that real estate upon your passing, they could subsequently, by rule, sell it immediately and not have to, recognize any tax liability or taxable gain. So it's really beneficial to own real estate when it comes to estate planning. And there's some capital gain and deferral and capital gain saving strategies as well that we talk about real estate and other capital gains as well. So Section 1031 is a like-kind exchange. So that's when you trade real estate for real estate in a way. So let's say you would sell your rental real estate property, you'd have a significant gain. You'd put the proceeds with something called a qualified intermediary, and it would sit there until you found another property to purchase. Right. And this is you deferring your capital gain, right? So the new property you purchase, is the cost basis of that is going to be reduced by the capital gain from the original property. So that's where you're deferring the capital gain. Qualified opportunity zones and qualified opportunity funds. So qualified opportunity zones are an aspect of the tax code where it kind of incentivizes taxpayers to, invest in economically distressed areas. So you'd be able to find this. They have maps of where this may be. It's specifically real estate, right? So they want folks to invest money in these areas so that over time they get built back up economically, and they do so by allowing you to defer capital gains and put them into these qualified opportunity zones, right? So you could do this with the sale, capital gains from the sale of a business, capital gains from the sale of real estate, capital gains from the sale of stock. So really a great deferral strategy. It is a little bit complicated, but if you're doing it the correct way, it could be very beneficial. And the same goes for Delaware statutory trust, another way that you could defer capital gains into commercial property or residential property that's held in the form of a trust. And then holding property long term, long term capital gain rates are much lower than short term. So holding the property long term, you get to generate that real estate rental income. You get to pay off, someone else is paying off your mortgage. You're deducting those expenses over time, and if you do sell it, aside from the depreciation recapture, the amount that you recognize on the original cost basis over that is long-term capital gains. So it is a more preferential rate versus if you were to hold it short term. And next is employer stock compensation. This may not apply to everyone, but if it does, I definitely think this is worth listening to. This is some pretty complicated information, so we'll get started. So choosing your election. So equity compensation is compensation that maybe your employer gives to your employees as a form of compensation, right? It's in the name. So there's a couple of things to pay attention to when you're choosing, if you have the opportunity to choose what kind of equity compensation you receive. So the risk versus reward is very important. We always say you don't want to have all of your eggs in one basket. So, I mean, think about if you're working at a company, you have your 401k at a company that might have a lot of employer stock of that company, and you're receiving equity compensation. You don't want to find yourself in a situation where you're really exposed, right? So if something, if let's say this company goes bankrupt, or not to be morbid, but things go south of the company, if you have a lot of your assets and retirement tied to the company, you're exposed, and you might not be able to retire when you plan on retiring if you don't kind of mitigate your risk in this regard. So there's a lot of tax consequences with receiving equity compensation and exiting it. So picking between options and restricted stock or your performance or PSUs, that's something to pay attention to. And like I said, managing taxes around vesting and exercising. You might be in a high tax bracket, and maybe you're retiring and you'll be able to be in a lower tax bracket, and that might be a chance for you to potentially exercise your options or sell out of some of the RSUs you have. So managing taxes, it's very important to work with a professional like a CPA or enrolled agent to kind of mitigate your risk and lower your tax liability. Last but not least, so the time frame you intend to stay at the company, right? So if you do have an option to select what kind of equity compensation you receive, the vesting schedule of the specific equity comp is very important, right? So let's say you do have the option to choose between RSUs or ISOs, and one has a more accelerated vesting schedule. If you're not planning to stay at the company for a significant period of time, obviously you're going to want to choose the equity comp with the accelerated vesting schedule. So these are the three things that come into play pretty significantly. And just going to run through the types of equity comp. So obviously we have stock options, right? This is an option to purchase the shares at a certain strike price of your company, right? It's not don't confuse it with actually receiving shares. So you're able to, it gives you the option to purchase, right? And there's an expiration date and there's a vesting date. So a lot of moving parts there, and also referred to as ISOs or non-qualified stock options. And then we have restricted stock units and awards. So they're units pledged by the company to give an employee shares at a later date, owned by the company at the grant, or owned by the employee at the grant date. So when the stock vests, that's when it is ordinary income to you on your W-2. And then when you subsequently, maybe sell and there's a little bit of a gain, that's capital gains. And on the flip side, we have performance stock units and awards, pretty similar to RSUs, but the only difference is that the amount that employee receives is based on the performance of the company, right? So it's kind of variable, the amount of equity comp you can receive when it comes to performance stock and units and awards. And then we have employee stock purchase plan, right? So really beneficial if you have the opportunity to purchase, your company stock through an ESPP. You do it through your payroll deductions, and you're able to purchase a stock at a discounted price, which could be, around 10 to 15%. But the one thing that, that I want to know is that eventually, when you sell out of that stock that you purchased through the ESPP, the discount that you received is ordinary income, and that's on your W-2. So those are the big equity compensation types. And lastly, we'll talk about tax implications, right? And I'm touching on this a lot because it is very, very important. What tax bracket you're in versus, when you're planning to exit equity compensation, these two things go hand in hand. You don't want to bump yourself up into a tax bracket, a higher tax bracket than you're in right now, right? So if you're in the 12% tax bracket and, if you, exercise and exit ISOs, you're going to be in the 24. These are the things that we monitor at the firm when we're analyzing, our clients and their situation when it comes to equity compensation. And then we have long-term and short-term capital gains, right? So, this comes into play. We want to have, our clients recognize long-term capital gains versus short-term, right? Obviously, the rates are more preferential, and they're much lower than short-term. So, but it's a balancing act, right? If you have ISOs and you exercise and do a cash exercise immediately, you're not going to be able to recognize those long-term gains. But if you're in a situation where all of your assets are exposed to the company, then we might say, this is a better idea to sort of, get out of all of this, equity comp that you do have tied to the company. So you might not be able to recognize long-term capital gain rates because of that. So it's a huge risk and something we monitor pretty closely. And then we have alternative minimum tax. This comes into play when you exercise ISOs, something we look at really closely with our clients. It's basically another tax added on to your taxable income alternatively, right? And it's really the spread on your ISOs that we add back, and you could potentially pay an extra tax for that. And then lastly, we have net investment income tax. This is, a 3.8% tax that high earners pay on investment income, something to, that we monitor. And, it's 3.8%, but if we're talking 3.8% on some large numbers, it could be pretty significant. So just something to keep in mind there, and I'll pass it off to Scott to end the presentation.
Thanks, Finney. As we leave Thanksgiving in the rearview mirror, we are officially in the holiday season. Often this time of year is associated with gifting to others, whether that's a family member or a charity. So there's a number of strategies that you could utilize if you are charitably inclined. The first one is bunching. Bunching is where you give a few years worth of gifts in a single tax year, and then in the subsequent years you give nothing. By doing this, your deduction may be enough to exceed the higher standard deduction that we saw as part of the Tax Cuts and Jobs Act. Another option is to donate appreciated stock from your brokerage account. By doing this, you avoid having to pay the tax on the capital gains, and you can also diversify out of a concentrated stock position that you may hold in your account. Another strategy to utilize is a donor advised fund. A donor advised fund is simply a separate fund or account that allows for an individual to contribute and receive a full tax deduction that year, and then you can distribute from the fund to a qualified charity over time. If you are also 70 and a half or older, you can make a qualified charitable distribution, or a QCD, from your IRA. A QCD is when you take a distribution from your IRA and have that money go directly to a qualified charity. By doing so, the distribution is non-taxable. Also, for individuals that are charitably inclined and have a required minimum distribution, this is a great strategy to satisfy either some or all of their RMD. You can also gift to individuals. So for 2023, you can give up to $17,000 per recipient. Next year, 2024, that limit will be going up to $18,000 per recipient. You will need to file a gift tax return if you give more than that limit to an individual. The amount that exceeds the annual limit, whether that's 17 or 18,000, will then reduce your lifetime exclusion limit, which currently is right around $12.9 million per individual. So you can give up to $12.9 million out of your assets without having to pay any gift tax on that money. In addition to gifting, you can also gift it. In addition to gifting cash, you can also gift property or assets to an individual. It's important to note that you are still held to that annual gift limit. When possible, you typically want to avoid gifting appreciated assets to an individual. The main thinking behind that is, when you give them the property or asset, they now will inherit your cost basis. So there may be a large capital gain issue for the recipient. Also, by gifting them the asset prior to your passing, you lose the potential for a step up in cost basis if the asset had passed through your estate. You can also use gifting to help pay for education. One strategy is to contribute to a 529 plan. These plans allow for after-tax contributions to grow tax deferred. And then when you take out or make a withdrawal of the money, it is tax-free if you use it for qualified higher education expenses. You also have the option to super fund these accounts with up to 5 years worth of the annual gifting limit. So for 2023, that means you could put up to $85,000 into a 529 plan without using any of that lifetime gift exemption, the $12.9 million. Though here, if you were to super fund the 529 plan, you still will have to file a gift tax return and make that election of, super funding the account. While there's no federal deduction for your contribution, you could receive a New York deduction if you are a New York resident and also you contribute to a New York 529 plan. For individuals, this deduction could be up to $5,000, and for a married couple, the deduction is up to $10,000. And then a final strategy that you may want to utilize is paying tuition directly to a college or university on somebody else's behalf. By doing this, it is not considered a taxable gift, and therefore you don't have to file a gift tax return. With this strategy, you are also not constrained by that annual gift limit of the $17,000 or $18,000. Now I'd like to just cover a few tax updates and also provisions that will be expiring. Back in 2017 is where we saw the Tax Cuts and Jobs Act come into place, which was a major overhaul of the federal tax code. Often people saw changes to their individual and business taxes as a part of the Tax Cuts and Jobs Act. However, it's always been in place where the Tax Cuts and Jobs Act and all of the tax codes that came along with it are going to be expiring at the end of 2025. So I just want to highlight a few notable provisions that will be expiring. First, you'll see that individual income tax rates will be changing. They'll actually be reverting back to the pre-Tax Cuts and Jobs Act brackets and rates as well. We also saw, as part of the Tax Cuts and Jobs Act, the standard deduction for filing status is nearly double. So with the expiring Tax Cuts and Jobs Act, we'll see the standard deduction drop in 2026. So for an individual, that'll be $6,350. And for a married couple filing joint, that'll be $12,700. Also, with the reduction of the standard deduction, you just want to note that the SALT cap, which is state and local taxes, that $10,000 will also be removed. So there is no limit or restriction, on your income taxes that you pay to the state, also your school and property taxes that no longer will be in place. We'll also see the return of being able to deduct job expenses and miscellaneous itemized deductions. So all three of these changes, with the standard deduction decreasing, the SALT cap being removed, and also being able to deduct a few more itemized deductions, you'll see a lot more people in 2026 starting to itemize like they may have prior to the Tax Cuts and Jobs Act, as opposed to taking the standard deduction. So definitely want to be aware if that applies to your particular situation. Personal exemptions also will be coming back with the expiring of the Tax Cuts and Jobs Act. So that just want to keep that on your radar. Also, as part of the Tax Cuts and Jobs Act, we saw qualified business income deduction be incorporated. So just as a reminder, that is a 20% deduction for income that individuals receive through a pass-through entity, whether that is REIT dividends or even a partnership that they may be a part of. And then a final tax provision that will be going away is the higher estate and gift tax exemption that will be expiring. It's been pointed out a few times, but that limit currently is at the $12.9 million per individual. With the Tax Cuts and Jobs Act going away, that exemption will be cut nearly in half to about $7 million per individual. Next, I just want to highlight a few credits and topics that we've been receiving more and more questions on. These credits include the Energy Efficiency Home Improvement Credit, the Residential Clean Energy Credit, and also the Clean Vehicle Tax Credit. These credits, along with what you need to do to qualify for them, tend to change year to year. So it's really best to consult a professional or an advisor like ourselves to find out whether or not they apply to your particular situation. I'll just touch on each one of the credits quickly. So the Energy Efficiency Home Improvement Credit, that basically relates if you do any updates to your house. Let's say you install energy efficient windows, there's a possible credit that you may be able to receive. The Residential Clean Energy Credit is related to any sort of larger home improvement project related to solar, wind, or geothermal. And then the Clean Vehicle Tax Credit, that's if you buy an EV vehicle, you could be eligible for up to a $7,500 credit on your tax return in the year that you purchase the vehicle. There's lots of qualifications for that. So if you have any questions, definitely consult somebody like ourselves, or even the IRS does have a search tool so you can find out if your particular vehicle that you're looking to purchase may qualify. There's also been a lot of confusion around the handling of inherited IRA RMDs ever since the Secure Act 2.0 came out. So in most cases, the inherited IRA will need to be depleted by the end of the 10th year following the original owner's death. So just as a quick example, if the original owner passed away in 2023, the account would need to be depleted by the beneficiary by the end of 2033. Also this summer, the IRS did issue further guidance on whether a distribution needs to be taken each year from these inherited IRAs. They clarified by stating if the original owner was of RMD age, then the person inheriting the account or the beneficiary would be required to take a required minimum distribution each year themselves. And then conversely, if the original owner was not of RMD age, no required minimum distribution would be required. Also, one thing to note is because of this poor guidance that we got, about 3 years after the Secure Act 2.0 came out, the IRS has waived the penalty for any missed RMDs for tax year 2021, 2022, and 2023. Going forward for 2024, they haven't made any announcements, so we're under the assumption that they will start hitting you with a penalty if you don't take your required minimum distribution out of the inherited IRA. Just so as I wrap up, I'd like to just quickly draw attention to our blog, which can be found on our website. On our blog, we post weekly articles on a wide range of financial topics. So please be sure to check that out to see if there's anything that may be relevant to you or somebody that you may know, just for some really great information. So now I'd just like to turn it back over to Steve for a few closing thoughts.
Thank you, Scott, Nicole, Vinny. As I shared with you, my colleagues love taxes, and it's alphabet soup in a lot of ways. The government doesn't make it easy, that's for sure. And we're fortunate. I always like to remind clients that for the most part, they engage our services to manage their wealth, but we do so much more. And tax planning is an important part of what we do. I'm blessed to have 4 CPAs in addition to Nicole and Vinny. Also, my son Ryan and John Millay are both CPAs. With Scott being an enrolled tax agent, we also have a 5th CPA that we have on retainer for next tax season, who is also an enrolled tax agent. So we're committed to planning for your taxes and doing as much in-depth analysis as we can. Without any further ado, I'd like to once again thank you for taking time out of your day. It's the holiday season. We have Hanukkah and Christmas and so many other holidays. I hope you enjoy those holidays, your family and friends, and more importantly, I hope you stay healthy. We'll have this up on our website real soon, and in the meantime, you be well. Thank you for joining us.